Lightspeed Commerce Inc., symbol LSPD on the TSX, trades just around $20. Its market cap about $3 billion, doesn't pay a yield. What does this business do? Well, let's get to it here. Essentially, this is a company that provides point of sale and e-commerce software solutions. The company provides its software solutions primarily to retail and hospitality customers, but even offers a leading golf course management software platform. I included that just for Brennan's benefit. It's a software that is used by over 160,000 mid-market customers in North America, Europe, and Australia. The viewer asks us if the slide from around $150 that actually went above that in August 2021 has finally been arrested with solid 2024 numbers and 2024 growth guidance, and how the valuations of the stock look today with it priced around $20. Now, I'll certainly take another look at Lightspeed, a stock we have reviewed here multiple times with the stock above $100. And as it slid from those ridiculous highs to its current $20 range, each time we have reiterated that until the company could actually prove it can produce a profit, the stock should be avoided. A take really that has been spot on to date. Let's start by looking at Lightspeed's year-to-date performance. If we see here, this is the stock chart year-to-date. It's down 23%. That's despite a pop after the company's announced Q4 numbers, and it's really what had the stock moving higher was its fiscal year 2025 outlook. Now, let's look at the company all-time here. This is over 5+ years. Lightspeed has had a wild ride over this time, pushing to insane valuations during the COVID tech bubble. Again, above $150 range, basically back to its original trading range on listing. Despite the silly valuations, the stock has produced nary a drop of cash flow over its history. Let's look at the growth here in the business. As we can see, tremendous growth in revenues. From back to March, the year end 2016, 39.9 million up to 1.23 billion over this past fiscal year. That's tremendous growth. Despite this growth, the company continues to produce negative cash flow and even produce losses operationally in its latest fiscal year. The near-term optimism calls for, and I'll put this in quotes, adjusted profitability in fiscal 2025, the current year, after the company trumpeted its $1.3 million US in total adjusted EBITDA for fiscal 2024. We'll take a quick look at whether the optimism is justified. Let's first look at the Q1 fiscal 2024 highlights. Total revenues, $230.2 million. That's 25% increase. Good increase there. That was driven by transaction-based revenue, which was up 40%, and subscription-based revenue was up just 7%. The net loss, however, $32.5 million or 21 cents per share. Adjusted EBITDA came in at $4.4 million versus a loss in terms of adjusted EBITDA of $4.3 million in the same period of last year. The company has a tremendously strong balance sheet, $722 million in cash. That's US, about $4.72 US per share in cash and cash equivalents. Let's look at that balance sheet in a little more detail. It's quite clean. Cash, again, that's US dollars there, and net cash, $722 million. So strong balance sheet, but it's not done through internally generated cash flow. The balance sheet also, as you can see here, over the last 3 years annually has been declining. That's because the company continues to lose money. Nevertheless, the balance sheet is a definite strength of the company. And I'm going to point out one observation, just anecdotally, that I've seen from monitoring small and mid-cap companies for decades. In certain market cycles, there are companies that kind of luck into raising almost too much capital. I saw this in the dot-com boom, recently in the cannabis boom that we saw in Canada. They lucked into raising almost too much capital, which sounds like it should never be a bad thing. But you see, the company does not operate like a good business many times when I see this. That would be a good business, would operate with an eye to really producing profits over the long term. because they have this massive cash buffer. In this case, Lightspeed had nearly at one point $1 billion in cash and no debt. And a culture can develop. I'm not saying that's what's gone on here, but I have seen this in the past. It can develop where profitability, which is hard for a growing business to achieve, is not the goal. And revenue growth, acquisitions, and other goals outside of this become the target because, to be honest, they're easier. And when the market finally asks the company to make some money, and it eventually always does, it can be difficult to turn the ship around and change the culture to one where expenses matter and you need to create a meaningful bottom line. That is when you get a management team, and we saw this after this current year. They trumpeted again that number of EBITDA figure of that's an adjusted EBITDA figure for the full past year of 1.3 million US. That's off revenues of 909 million US. That's rather pathetic margin. Let's look at let's just look at the outlook and guidance that got the market excited for this company for its fiscal year coming up. Lightspeed, Buzz Lightyear. Now it's Lightspeed expects meaningful expanded adjusted EBITDA profitability in the coming year, which will be growing the company's gross transaction volume, or GTV, customer base, and subscription revenues. The company also expects to continue to increase the proportion of its GTV that is processed through its payments platform. Lightspeed will continue to balance growth in both revenue and adjusted EBITDA as it scales its business. Well, I would say they haven't done that in the past. They're going to continue to try to do that going forward. To beyond the 1 billion in revenue level. The company expects subscription revenue growth to be better in the second half of the year than the first. In addition, owing to the steep climb in gross payment volume, or GPV, as a percentage of GTV that occurred in fiscal 2025. Transaction-based revenue growth is expected to be stronger in the first half of the fiscal year than the second half. As a result, the company's outlook, you can see it there, first quarter 2025 revenue of 255 to 260 million, with subscription revenue growth for the quarter consistent with the past quarter, or the quarter we just saw, Q4 2024. Adjusted EBITDA of approximately 7 million. For the full year, revenue growth of at least 20% and adjusted EBITDA of 40 million. All right, let's get to the valuations based off this and on a trailing basis. We can see here is a summary. Because there's no profitability, we use EV to revenue on a trailing 12-month basis. That's 1.8. EV to adjusted EBITDA. This is based on management's estimate and some estimates out there, about 35.5. Again, this is a forward estimate. I have a question mark there because it is based on kind of some optimistic estimates. PE doesn't exist because there is no true earnings in this company. Let's look at my conclusion here. Overall, considering where Lightspeed has been in terms of continued annual losses, Q4 2024 was a relative positive, but what gave investors more hope was the fiscal year 2025 guide, which stated that the business can grow greater than 20% organically while driving better than expected margin expansion. The company guided to adjusted EBITDA for fiscal 2025 at a minimum of 40 million versus consensus heading into this announcement of 22.7 million. So a significant beat. Again, adjusted profitability, it's moving in the right direction. I stress it's adjusted profitability, and the guidance still implies only 3.7% margin. That's still very low. In the end, celebrating a fiscal 2024 adjusted EBITDA figure of 1.3 million US off 909 million is not a great look, really, to me. The company should have been focusing on producing cash flow years ago, and its current profitability margin remains rather pathetic. The ship may finally be turning in the right direction, but it is not there yet. Even if the company reaches its optimistic analyst estimates out there, the stock trades at over 35 times EV to EBITDA, which is a premium valuation for a company that does not yet deserve the benefit of the doubt. The growth and strong balance sheet is intriguing, but we find growth with real profitability elsewhere and continue to monitor Lightspeed near term. Okay. I'm finished.
Yeah, I mean, this is
See if you got any
this is one of
comments.
those companies that, for a time was just highly, highly touted. Investors really excited about it during the pandemic when the share price was skyrocketing. But we'd always said, I mean, it's a company they've never been able to really validate themselves with bottom line profitability. With revenue growth, yes, certainly.
Tremendous revenue growth. It's a great
Yeah,
success
yeah.
story on the revenue run, but you at some point you got to
At some
make
point
money.
you have to drop something to the bottom line. Are they able
Yeah.
to do that? Maybe they do over the next year here, but it's still, to me, it's still a precarious situation
Yeah, and
with
I do
respect to
believe,
profitability.
like I said, the balance sheet has been a bit of a crutch for this company, and I have seen it in the past. If they raised a ton of money at an opportune time. Good on them for doing that. But the culture in this company, they've never been able to produce a profit. Now they're just getting towards that now, and your guidance for the year implies like a 3.7% adjusted EBITDA margin. So when will you get to actual profitability? I mean, they're turning in the right direction. That's nice to see. And again, they do have a good platform. It's confirmed by the industry, the sales that you see in the industry. But when can you turn it into actual profitability? The more you bet on companies that are losing money over time, the more you lose. So there's just been so many businesses since we've been asked about Lightspeed over the past 5 to 6 years that have had both growth in revenues, growth in cash flow and profitability, have good balance sheets, and they've done tremendously well. And Lightspeed, it's not a surprise to me until they can consistently prove profitability that their stock price has languished over the long term.
Yeah, it's, just on the golf course management system. Of course, I have to touch on that. But because it is funny, just anecdotally, I was talking to my buddy AJ, who lives in Vernon, and he actually golfs at the Rise, which is a course there. And he was raving about the fact that he can use this app to essentially be on whatever hole he wants, and he can order whatever food, and they will have it ready at the clubhouse basically when he gets to the ninth hole. When we had this conversation literally 2 days ago, I didn't realize that it was Lightspeed's product, basically, that the Rise golf course is using. But, like you were saying, people like the platform. AJ, my buddy, was just raving about it. But of course, I don't know how much it would cost a golf course to run or to basically have the subscription or software per year. I'm sure it's very pricey. But according to Lightspeed, they were able to increase the Rise golf course's revenue by 190,000 in top line revenue. Again, I don't know exactly how they're doing that, but anyways, just thought I'd touch on that since I'm a golfer.
The turn of the ship, the pointing in the right direction, this finally starts to get to our attention. But again, we've been asked about this company at like $50, $100, $150, and then back at 120, 100, and down to 90. Is it finally value now at 90? Is it finally value at 75? And all the way, $50, it must be value now, 40. Well, it's almost back to where it was. And, until they start to show cash flow positive profitability going forward, the risk is too great. So you're catching a falling knife in a business that just, is a house of cards until it can produce profitability. Again, it started to point in the right direction. We'd be more interested in talking to management right now than we were at any time in the past 5-6 years.
I will say on as well. So Ryan was quoting adjusted EBITDA, which always I like to look into what they're actually adjusting out. So for fiscal 2024,
that's why I say adjusted.
Yeah,
I don't know
you got to make this very clear because they can roll some stuff into it, which is awesome. Nothing's really unstandard here, but they had just under $74 million in share compensation in 2024. So if you're just thinking about looking forward, assuming the stock price doesn't change much, that's really the main movement when you're looking at share compensation. If you just took that out, they'd still be at an adjusted loss or an EBITDA loss at that point.
Yeah.
Of 34 million. So it's not like it's doing great because when you're looking at share compensation, really you're just funding your employment expenses through share compensation. You could issue the shares and pay your employees cash. That's obviously you want to get your employees invested in the company, so there is an upside to it. But financially, that's what you're doing. So I would like to point out, they are really still financing their company, even in this adjusted EBITDA figure. They still, if they're able to grow 2 or 3 more years at the same rate, then without that share compensation, they would be in a positive figure. But as well, I will say, in their figure, since they do have such a large cash balance, which is about a third of their market cap, they're actually adjusting out quite a bit of a net interest income. That's the I in your EBITDA of 43 million. So they are actually taking a bit of a hit, which you won't see in many companies, where it actually gets dragged down by a figure like that.
Yeah.
But then on the flip side as well, if we see interest rates drop back down to 1-2%, that figure goes away as well.
Yeah, at least we're not seeing like an adjusted EBITDA figure and this company had 600 million in debt or something, because there are companies that we get asked all the time, even in the software space, that have 600 million in debt, and they're adjusting out that they're not even including the interest expense, really. It just makes it the companies aren't, it's a real expense for these businesses. Anyways, let's move on. I think we beat that to death. Again, it's a company now we would start to take a closer look at the business. But you'd really be, the thing is, for me, you're relying on management's guidance in a company that has never done it, right? They have never produced the profitability. So you really you have to believe in the team. And that's often, it can be, you're really just putting your faith in that, in a business that hasn't been able to do that in the past. And, you want them to get to like 20% margins, not 3.7, right? So, can they do that? If they can, then you could have a significant lift in the stock, but it's not there yet.